Screening services and ESG screening tools are widely used by investors to evaluate companies, securities, funds, and portfolios against predefined environmental, social, governance, ethical, or sustainability criteria. These services help investors identify investments that align with specific objectives, regulatory requirements, fiduciary responsibilities, or values-based preferences. ESG screening providers collect and analyze large volumes of corporate data, disclosures, regulatory filings, news reports, and third-party information to support investment decision-making. Screening tools have become increasingly important as sustainable investing has expanded globally. They enable investors to apply systematic filters while improving efficiency, consistency, transparency, and scalability across large investment universes. The main providers of ESG screening services include specialized ESG research firms, sustainability rating agencies, financial data providers, and index providers. Organizations such as MSCI, Sustainalytics, ISS ESG, S&P Global Sustainable 1, and FTSE Russell provide ESG ratings, controversy assessments, exclusionary screening tools, climate data, governance evaluations, and portfolio analytics. These providers serve institutional investors, asset managers, pension funds, sovereign wealth funds, and financial advisors by offering standardized ESG information that can be integrated into investment processes and portfolio management systems. Although screening providers pursue similar objectives, their methodologies often differ significantly. Providers vary in their definitions of materiality, data sources, scoring systems, weighting approaches, industry classifications, and assessment criteria. Some emphasize financially material ESG risks, while others focus on broader sustainability impacts or stakeholder outcomes. Certain methodologies rely heavily on company disclosures, whereas others incorporate alternative data sources such as media reports, regulatory actions, litigation records, and stakeholder feedback. Differences in methodology can result in substantial variations in ESG ratings and screening outcomes for the same company. Consequently, investors should understand provider methodologies rather than relying solely on headline scores. Screening tools generally support several approaches, including negative screening, positive screening, norms-based screening, and best-in-class screening. Negative screening excludes companies involved in activities such as tobacco, controversial weapons, gambling, or fossil fuels. Positive screening identifies companies demonstrating strong ESG performance or sustainability leadership. Norms-based screening evaluates compliance with international standards such as human rights principles, labor standards, and anti-corruption frameworks. Best-in-class screening selects companies with superior ESG performance relative to industry peers. These approaches help investors align portfolios with financial objectives, regulatory expectations, sustainability goals, or ethical preferences while supporting more systematic investment decision-making. The primary benefits of ESG screening tools include efficiency, consistency, scalability, and improved risk identification. Screening services allow investors to evaluate thousands of securities using standardized criteria and support portfolio construction, due diligence, stewardship activities, and regulatory reporting. They facilitate comparisons across companies, industries, and regions while helping investors identify potential ESG risks and opportunities. Screening tools also reduce research burdens and provide structured frameworks for integrating sustainability considerations into investment processes. For organizations managing large and diversified portfolios, ESG screening services offer valuable analytical support and improve the ability to implement sustainable investment strategies effectively. Despite these advantages, ESG screening tools have important limitations. Data quality may vary across companies, industries, and regions, and many ESG metrics remain self-reported and inconsistently disclosed. Different providers often produce conflicting assessments because of methodological differences, creating challenges for investors seeking reliable comparisons. Screening tools may oversimplify complex ESG issues by reducing them to numerical scores or binary classifications. They may also fail to capture qualitative factors, emerging risks, or company-specific circumstances. As a result, screening services are most effective when used as part of a broader ESG integration process that combines quantitative outputs with qualitative analysis, engagement activities, and independent investment judgment.